Welcome to the July 25th, 2022 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your fast-paced weekly global tour of the markets and a rundown of the headlines that could be steering you the right way or the wrong way. So we're going to dissect those. I'm president of McGowan Group Asset Management, a team of 10, the team that cares, serving clients, affluent clients, with brainstorming sessions, great plans, and portfolio management that takes into account cash flow as well as forward projections that help us to make good decisions. When the markets disappoint and you see value at risk of loss, there are responses that can actually get you pay raises, and we're going to cover some of those as we go through the headlines. Now, headlines have been overly negative. You've heard looming recession, inflation, endless talk of the Federal Reserve and the tightening cycle. Well, there were some important headlines this week that you may have missed, and there's some good news built in here. What is this? This, and the charts and graphs are at NetWorthRadio.com if you want a closer look. This says 104 companies out of the S&P 500 have reported earnings. And this green bar right here says that 75% of those companies beat profit expectations. And further, there was about 60% of those whose sales were better than expected. Wow, that's actually some good news. And it's not consistent with all the recession talk you've been hearing, at least not yet. Now, this is a very similar chart, but this is the actual growth in sales. 7% is the growth in sales over last year. What is that? Well, that's not a contraction in sales, is it? And earnings growth, well, it says a minus 6%. So profits did go down. That was primarily financial companies. Who has not reported yet that's already said they're going to make record profits? That's not factored in here? The energy companies. The energy companies report at the end of July and August, and they've already pre-announced it's going to be great. Well, that's not a recession either. And it looks like by the time they finish, you have actual profit growth and a 7% sales growth. Well, that's good news because it's the opposite of the headlines that could lead you the wrong way by being overly pessimistic, and we don't want to miss bargains that can give us pay raises. All right. And I would say that high yield bonds have reached a point where they are so deeply discounted and they have such a huge advantage over Treasury yields now that you've probably got a good point on that category. Not a recommendation for your portfolio until you actually get a plan from McGowan Group Asset Management. Now, second quarter growth in the economy. This is a forecast that it will be slightly positive real economic growth, and it looks like about a 7% inflation rate subtracted from about a 6% growth rate in the dollar volume of the economy. That's a stealth recession. And they said, Atlanta Fed says this is going to be a minus 1.2, maybe a minus 1.5, because inflation has temporarily run so hot. Well, that's a type of recession, but it's not this contraction that most people associate with like a 2009 or 2008 collapse in the economy. It's much different from that because you still have jobs growth. 372,000 net new jobs last month, in the month of June. What is that? That's not a contraction in employment. People are actually finding great jobs, and there's 11 million jobs out there waiting to be filled. Now, what is this? This is the forward forecast of what the dreaded Federal Reserve rate increases are going to be. Guess what happens? When they define where they're going to go, the capital markets usually have a relief rally, especially in assets that are undervalued with great cash flow. Well, it says in September they're going to go to 3% on the interest rate. Well, okay, let's take a quick look. That's September. Now, 2.3% is the July increase. That means, what are they going to do? And I'll show you right here. This is the base rate for lending, or the cost of capital. It went to 2.5% back in 2018 in that tightening cycle. Once they defined where they were going to go and when they were going to wait and see, the S&P had been down 20% and it recovered in about 4 months. That projection, obviously it's going to be different this time. However, where are they going to go? They're 1 3/4 here. If they go up 3/4 in December, which is expected, that's going to be a base rate that is 2.5% right here. And then if they do another increase in September, they really are going to define that likely on Wednesday, July 27th. Once they do that, the capital markets will figure out how to adjust for the higher cost of capital. Interest rates have already gone down on the 10-year Treasury. You've gone actually from 3.5% down to about 2 3/4%. Why would that interest rate fall? Some of it, people may be expecting a recession. The other is that the Federal Reserve is expected to define the end of the tightening cycle. It could be a huge disappointment if they don't define the end of it, by the way, and we'll deal with that if we get it. Opportunities are created during the tightening cycles in the bond markets and in the equity markets because stuff gets cheaper and has a higher forward expected return. This is the S&P year to date. It dropped at the worst point down over 20%. What's happened since June 15th? Probably hadn't seen this either. A relief rally. The S&P's up 10% associated with those earnings. Was that the bottom? Well, it typically looks like that when you have a huge pessimistic sell-off. Could go lower, but it does say you may have washed out with all this negative sentiment. One of the pressures, of course, was energy. Oil here, it actually reached a high of 130 intraday, but 124 on this chart, and oil's come back to about $96. That's more of an equilibrium where you do not get demand destruction. That's going to be important, saying that you're not going to kill the economy with excessive prices, and gasoline prices have moderated, commodity prices have moderated. Wanted to bring you some of the good news that's actually going on, because the rest of 2022 may present some great opportunities for those that manage their portfolios with great assets. I'm Spencer McGowan, President, McGowan Group Asset Management. Thank you for joining us. Be sure to subscribe and send the link to those that ask you what's going on in the financial markets. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.